But stock of the day, I thought, considering we've got the ETF Whisperer on board today, I thought we'd do a little ETF focus for stock of the day on shorting the market. Yesterday, we saw the biggest intraday drop in more than 2 years. So let's check in on where the local index is sitting at the moment. And it's still, it's up from the open, but still down on the day. But Andrew Wielandt, a lot of people have been saying Gary Glover has been in the SNAS, is it, where you can short the NASDAQ and made a heap of money. Is this an easier way than doing an options play to build a bit of a safety net under your portfolio, and what's available?
Yeah, Koshy, lots to unpack with that question. So I guess the first thing is all the ETFs that we've been discussing over the 3 years that you've been lucky enough, or we've been lucky enough to be talking about them here on the call, have been physically backed. So even when we talk about CRYP in a minute and all the excitement that brings to those holders, there's still something tangible, there's still something physical behind it. In this case, the shorting ones, there's not. We're actually dealing with derivatives, and in most cases, we're dealing with futures. And so that to me is an immediate amber, if not red light, because that's certainly something in my world. You know, I like something physically back. Now, we can go back to Henry's days on the floor of the Australian Stock Exchange, and prior to that, his work in the LSE. You know, like for people who are trained and specialists, that might be something for their world. But, you know, for the average retail investor, I don't think it's necessarily for them. So that's my bias I'm bringing to this conversation. In the context of the tools available, there's a few of them out there. There's BEAR, B-E-A-R. So it sort of has a one-for-one, or the purpose is to have a one-for-one inverse relationship to the market. So in theory, if the market is going down 1%, then BEAR should go up 1%. Again, it's using futures. Another BetaShares product is BBOZ, and I know Henry has that in his portfolio that he has on his website. And that from memory is between 2 to 2.75 times in theory. And, you know, sometimes the theory doesn't work out because there's a mismatch in the timing. And then, as you just spoke about ETF securities coming to the party, both have a long NASDAQ, LNAS, and a short NASDAQ, the SNAS. Sounds like one of the characters from the Housewives, doesn't it? Anyway, SNAS has been certainly flavour of the month, and in fact, it's got about double the funds under management relative to long NASDAQ. So certainly they're the four that immediately come to mind. I'm sure there's others, but they're probably the four more popular ones out there. But to your point, Koshy, around are they the ones to be using? I guess this sort of comes back to the whole reason why I recommend ETFs, when I recommend ETFs to clients, it's simply around the fact that, with due respect, the three of us don't know where markets are going. We might have an expectation, we might have a hope, but at the end of the day, we don't know. And if we get it wrong and we're using something that's geared, or we're using derivatives, or a bit of both, then we are potentially setting ourselves up for pain. And I'm personally not into pain. Whereas if we are sort of going, well, markets will do what markets will do, and I can determine the return by having a spread of assets, you know, Australian shares, international shares, property, infrastructure, etc. That's how I'm going to minimise my risk. It's not by using a derivative. It's not by using gearing, because these things are quite expensive as well, as they have to be, because there's lots of moving parts under the hood. You know, like I think it's bears about a 1.3% management fee. If we compare that to, say, a very simple ASX ordinary ETF like STW, which is 12 basis points. So you're basically paying 10 times the cost. So, Koshy, all really interesting stuff. Trading, that's fine, me personally.
Henry?
Well, I would disagree completely with what Andrew has said, I must admit. I think these, you know, if you're going into battle, you need every tool that you can. You need every weapon in your quiver. You need as many swords by your side as you possibly can. And these things are a valid way of hedging market risk, albeit some of them are geared, some of them are not geared, and they do what they say on the tin to some extent. To a large extent, obviously there are some limitations. And if you're worried about the management expense of these things, I think you're missing the point. These are sometimes short-term trading instruments that give you protection. Now, you can go to cash. That's fine. If you've got a big portfolio, you can go to cash, you can sell everything. But as one gentleman told me last night at the AIA, the problem is you go to cash, you got all those tax problems, and you have to employ a financial planner and an accountant to sort all that out, plus the brokerage. These things are a simple and easy way and very well established way of hedging your position on a short-term basis in your portfolio. And certainly, I've held BBOZ as an insurance policy for some time. And yesterday I actually sold out of some when the market was down 350 because I thought we might get a little bit of a bounce. We did, but not sufficient. But certainly, if you've got a view and you're worried about things and you can't sleep at night, then having an insurance policy is a great way to go. When you buy a house, you don't go, well, you know what, I don't care if it floods or there's a fire. I don't care. I'm quite happy to sit there and accept that, because if I buy some insurance, it's leveraged or it's got some sort of futures derivative exposure. That's nonsense. These things are pretty well established. They're big, they're known, they work, and they are great short-term ways to hedge a portfolio. Well, if I'm an old derivatives trader, I'm an old options trader from many years ago. If I could, I'd use puts instead, but we're not licensed to do that, and so that gets a bit complicated. But BBOZ or Bear is really simple. You know, it does what it says. If the market goes down, goes up 1%, these things go down. They go the opposite way. So it's not difficult stuff.
Okay. All right. Yes, Andrew.
Yes, Wielandt at the front. All I was going to say is I think that conversation perfectly illustrates the two different ways that Henry and I look at stuff. Henry's active, I'm passive, and so it depends on which way you're looking at it. And I think everything Henry just said has got lots of merit.
Okay.